Hello and welcome to this edition of The Market Share. I'm Paul Gifford, Chief Investment Officer at First Source Bank, and joining me today is Rob Romano, our Director of Research. Rob, this is the first of 3 videos as we start talking about our 2024 outlook for the markets. Now, it's been kind of fun. We've actually had positive equity markets, positive fixed income, and even positive money market returns to talk about this year. Let's start out, though, kind of where we are with equity markets today and what we see in 2024.
Yeah, Q3 earnings came in up about 4% year over year. That's versus expectations of roughly flat. So that was a solid beat on the quarter. And it was the first quarter where year over year earnings were higher than the previous year in Q3 of 2022. Operating margins were down year over year, but were kind of leveled off and have plateaued. And much of that really has to do with the cost cutting and the right sizing that we're seeing from corporate America. And we think that theme is really going to play out into 2024. Just to give you a couple examples there. One is Facebook. Facebook came out and said that they trimmed their workforce 24% year over year. So if you can think of that, in a matter of a year, Facebook lost almost 1/4 of their workforce. Disney, on the other hand, they're dealing with some challenges around media and the changing landscape there. They announced $2 billion in cost cuts. That's on top of an already announced $5 billion restructuring. So, Paul, the year of efficiency continues. When we look at 2024, right now analysts are expecting earnings of about 10 to 11%. We think that's a bit optimistic when you consider commentary from Chairman Powell about being higher for longer, and also the higher cost of capital and what that may mean for consumers and small business.
Our team seems to agree that 10 to 11% growth is a little bit optimistic as we look forward. And we also are a little bit concerned about the consumer and how fast inflation continues to come down. Both consumer spending and inflation will impact, obviously, corporate revenue, which is a big piece of the puzzle when we look into 2024. So why don't you talk a little bit about corporate revenues?
Sure, definitely. You know, we continue to expect the economy to slow in 2024. And with that, we think inflation is going to continue to work its way lower. But that's going to present some challenges, especially for companies to grow the top line, to grow revenue. And we saw that in Q3, where 61% of companies beat that revenue expectation. That was versus the one-year average of 69%, so materially lower. Revenue is part price and part volume. And on the price side, we know corporate America really benefited from inflation. And they passed a lot of those costs on to consumers. We heard that from Pepsi, from Procter & Gamble, even technology. But as the economy continues to slow, inflation moderates, we think it's going to be very difficult for companies to pass along higher prices. So that's part of the equation. The other part is simply volume and transactions. So, you know, we've heard from the likes of Walmart in the past couple of weeks, Home Depot, and also Lowe's. And they all mention slightly less traffic in the stores and also less transactions. So on this graph here, what we have is we have the restaurant industry, and we broke it out according to category. So we have the quick serve, which is your fast food like McDonald's. We have the fast casual, more like a Chipotle. And then we have the casual dining, which is more like a Applebee's or Chili's, and then a fine dining, which would be a Ruth Chris. So what the chart shows is that across these different categories, transactions are down meaningfully in Q2 and Q3, except in that fine dining category. So again, as we look to 2024, we think those companies that can grow revenue are going to receive a premium valuation. And we really think those areas are going to be healthcare with the slowing economy, technology, and again, we're fans of that mid-cap asset class also.
So Rob, obviously there's a lot of metrics that we use to measure valuations. You just talked about trying to find where the valuations are and which would earn a premium to that. One of the metrics that we haven't talked about recently is earnings yield. And now that interest rates are substantially higher, how does that impact valuations in the stock market with us having higher interest rates?
Sure. Google publishes their top searches for the year. And one of the most popular searches was CD rates. So it's not a surprise. Investors know rates are higher. They're searching for ways to take advantage of the higher rates and lock in those rates. So today we're going to talk about T-bill yields and also the S&P 500 earnings yield. Now, what the S&P 500 earnings yield is, that is the opposite of the price to earnings ratio. So it's a way to measure the valuation between asset classes. So on the graph here, you can see we have a T-bill yield at roughly 5.3%, and then the earnings yield is at 4.6%. And if you look at historically on that graph, it's been rare that the T-bill yield has been higher than the earnings yield. And historically, when we've seen that, that has been a more difficult time for equities. So again, as we head into 2024, we think fixed income is attractive, but we also think fixed income is going to compete with equities for investment dollars.
Yeah, that's really sound advice and really where the team is thinking about today. Rob, as always, thank you for sharing your thoughts with our clientele. If you enjoyed today's video, we encourage you to share that with friends and family and colleagues. And if this is your first time watching the market share video, we encourage you to subscribe at firstsource.com. And as always, thank you for the opportunity to serve you and your family, and have a great day.